everyone. Welcome to my channel, the PIIverse. My name is Perry, and we got an exciting video lined up for you here. I'm hoping it's going to be value to you and some education. This is actually my second take. I had one for the very few of you that saw this happening. About 2 days ago, I did this video already. By the way, Perry here. Welcome again to my channel. I want to basically say that this is my take two of this. I already apologized on the post there as well, but I did do this video about two or 3 days ago, and I thought everything was good. And then, you know, we all make mistakes, and I was one of them, and I made the bad assumption of assuming that one of the new ETFs that I was very interested in was a covered call ETF, like they pretty much all are, but this one surprised me. And the mistake was enough that basically the entire video was compromised in the sense of my strategy on rebalancing was basically, I had to really rethink the whole thing. And basically I have rethought my entire rebalancing once I understood what these cover call ETFs were. They were, by the way, from Roundhill, and they were called the week pays. And again, like I said, I thought they were cover call ETFs with leverage. They are not that. They are leveraged swap agreements, which are quite volatile and very higher risk, and not something I typically would invest in. So I had to rethink it. I had to get a better understanding exactly how they worked. Again, I wasn't saying that I wasn't going to buy into them, but I had to understand them and then say, based on the risk portfolio of these guys, what would I do? Would I ignore them completely, or would I basically say, let's do it, but let's just dip our toe in it and that? And we're going to talk about that in this strategy. I can honestly say, take two of this. The rebalancing outlook is going to be different than it was on the first version. So for those that just wanted to give you a recap, this is going to be a new how do I rebalance. So I'm actually reduced what the last one said, but I'm going to basically, by the end of this rebalancing, I'm going to be increasing my monthly balance or my monthly income by $900. But there's also some other major benefits to this in addition to the $900, and we're going to get into that. And so I'm looking forward to this video to explain to you. And I'm calling it the anatomy of a rebalance because, again, my channel really, I know there's a lot of covered call ETF and income-based ETF, income-based YouTube channels out there, but I really am trying to carve a niche in the YouTube channel world with regards to income investing, that I really want to focus on strategies and understanding the big picture on things. You know, if you've watched my videos, you see I don't often talk much about what I'm holding, or I'm not comparing one ETF to another ETF, because really they're just assets to the portfolio. It's more important for me to understand the strategy and how I'm going to manage it, and what assets go in it are just basically a small piece, believe it or not, of the entire portfolio. So in light of that, this video is going to be trying to explain to you why do we do a rebalance, and what does a rebalancing and analytics look like. So hopefully it helps you better understand when your portfolio starts growing, that you say, okay, now I know what I need to look for when I'm rebalancing. Okay, so let's get started. And then the first thing I want to talk about, because I've seen a few people on my Blossom channels, my Blossom community, and even inside the YouTube videos, channel comments, sort of saying, well, hold on a second, Perry, you keep on saying that you're a buy and hold investor. So if you're a buy and hold investor, why are you selling off assets and selling them and rebalancing, quote unquote? Because doesn't that go against your whole strategy of saying I'm a buy and hold? And so I do want to answer that question. So what I'm going to do is I'm going to take you to, I really need, for those of you that are watching my channel or this video as the first one of anything you've ever seen from me, I want to introduce you to, take you back to my video that is the sort of like the crown jewel of my videos so far, and that is my playbook, my PIIverse playbook, which is basically my strategy document. It looks like this. I think, I'm not going to quote the exact date, but it was done about 3 weeks ago. I will, as I'm saying it right now, you look up in the upper corner and you will see the link to that video. But this is what this video looks like. If you are looking at this video for the first time and wondering things like, why are you rebalancing and what are your goals? I really strongly advise anybody who has not seen my strategy document, or my strategy video, is to watch this video. Again, it's called my PIIverse playbook. And again, I got the link up there for you. The reason I'm pointing this out is that when somebody asks the question, why are you rebalancing if you're a buy and hold investor? Well, the strategy actually explains it very clearly. So if you watch the video and you go into, eventually when you get to my slide 6, it'll look like this. And these are my investment goals that are driving my strategy. So these are the primary goals for my portfolio strategy. The first one is to maximize monthly uninterruptible income and cash flow. So again, I want a portfolio that is always looking to maximize my portfolio, not just on the inception, but the more important thing is the number 2. My goal number 2 is to always look at ways of growing my annual average income, so that I'm not only fighting inflation, but also dealing with some of the limitations that covered call ETFs have that are more on the ultra yielding side, which some can incur some erosion, as well as some just have occasional lags because they slowly over time basically have capped upsides. So you'll see that they may have some lagging behind. I call it NAV lag. So there's a big reason that I always need to continue looking at ways of growing my monthly income. And that's what this one's all about. So when you look at this thing on how I can annually grow my average income, this will take you eventually to slide 11. And the strategies used to basically deal with my goal of growing my portfolio is that there's only 2 ways to do it if you are not contributing into your portfolio. And for me, just for those that don't know me well enough, my portfolio is fully self-funded. I have not contributed into my portfolio in over 2 years. The only way it grows is by 2 ways. One, by reinvesting my income. Oops, sorry about that. I didn't want to do that yet. And now make me apologize for that one. So one way to do it is by reinvesting, and that's the primary one. So of the money that I make every month, I reinvest it, and that helps it grow. But that's not the focus of today's video. Is the one that is not talked about as much, and that is the rebalancing strategy. So basically what you're doing when your portfolio continues to evolve, you're always looking for ways of fine-tuning it so that you can migrate away from lower yielding holdings over to more higher yielding investments. Also, you can actually do things like trimming excessive unrealized capital gains to reinvest back into higher ETFs. And in some cases, you just want to say that maybe I've basically over time, some of my cover call ETFs or my holdings in my portfolio have actually grown too much in target weight, and it's over my target weight, and I actually might want to reconsider rebalancing it. So that's another reason that I would look at for rebalancing. In the case of this rebalancing that we're talking about now, it is because of my plans of actually lowering the target weight on the target ETFs that I'm looking at, I'd say balancing out of. And that's what the primary thing is. And if I'm going to do it because I want to sell off part of this position, and of course it generates proceeds, of course the rebalancing has a second part of it, is what am I actually selling so that I'm going to generate new monies or cash balance that I can actually buy with. And then the second part of a rebalance is I've got the cash, so what am I rebalancing to? So what am I rebalancing from? And then what am I rebalancing to? And so this is the process of the rebalancing that I'm going to be doing today to show you. All right, so I'm going to go back to here. So that explains the why. So buy and hold is a primary objective, but it does not mean that I never sell my assets. I don't buy something and hold it forever. I very often always watching my covered call ETFs and my assets in my portfolio. And I'm almost looking like, is there one that's maybe gotten long in the tooth and stuff? And so, yes, rebalancing happens even in a buy and hold strategy. Okay, so that explains the why am I doing it. So now let's continue the anatomy of the rebalance, and let's talk about what, in this case, I'm looking at rebalancing. So I'm going to take you to our spreadsheet, or my spreadsheet. All right, so this is my beloved overcomplicated spreadsheet that I basically live and breathe my portfolio from. And by the way, before anybody asks me in the comments of this video, hey, I love that spreadsheet, are you willing to sell it or give me a copy of it? I can maybe sort of head it off at the pass and say, I'm honored that people want this spreadsheet, but I don't sell it. It's just too complex and it has too much care and feeding. But again, I'm going to point it up into the upper corner. If you're interested in building your own spreadsheet sort of like this and need some inspiration from it, I'm going to point you up to another video, which was the first one I ever did for my new YouTube channel. And it is a deep dive of this spreadsheet. So if you're interested in this spreadsheet, so that you might be yourself an Excel nerd and say, hey, I could do that, but I just need to know more about your spreadsheet, click the link above and you can basically go and have a full 1-hour tour of this entire spreadsheet. Okay, so now let's talk about what it is that I was looking at rebalancing. I'm going to focus on them right away to the targets. This, just so you can look over here in the corner, these are all my holdings. I currently have 3 growth stocks, which are out of the picture here, so don't even think about them. And then I have 29 ETFs from number 1 HLYD all the way down to Coney is my last one. The ones that we're going to look at are the 2 pairs. There's the pair called from Roundhill called QDTE and RDTE, which is the NASDAQ weekly paying 0 DTE cover call ETF. I'm just going to switch over to the side over here. Hang on a second. I got a suspected spam here. Anyways, so I'm going to go right over to the end over here. So these 2 here, I have a large holding of them, 1,900 shares. I've held QDTE and RDTE for over a year now. That's 13 months. And the reason I'm bringing them up is because lower down, number 19 and 20, is QQQY and IWMY. They are from Defiant, which if you want to compare these 2 to these 2, they are direct competitors to each other. They both do NASDAQ Russell. They both are doing weeklies, 0 TTEs. And their strategy is actually even becoming more aligned because I just heard an understanding that Defiant is actually changing their strategy and moving away from, if I remember correctly, and do your own research, but from what I understand is Defiant is actually moving away from secured put strategy to a covered call strategy, just like pretty much everyone else does. Roundhill has always been doing covered call strategy. So these 2 are almost going to be very close together. So the reason I'm bringing them up, this guy, you can see these 2 here. I've held them actually longer, double. I've held QQQY and IWM for basically a year now, 24 months and 22 months respectively. So the next question is, the reason I'm looking at these 4 is because I'm overweight, in my opinion, in the NASDAQ and not the Russell as much, but more so the NASDAQ position. If you look over here, and this is the part that was concerning me here, you can look right here and you can see that my target weight, which I'm looking at reducing down to about 3%, but my target weight currently for QDTE is it makes up 6.2% of my portfolio. I have a rule that basically says that I should not have any ETFs or any assets holding more than 5%. I break that rule every once in a while and I consciously do it and say, okay, Perry, if you're going to go over 5, do you know why you're doing it? So it's not as if I must be under 5%, but it's rare that I am. In this 2 cases here, I thought back a year ago that these 2 might be a very strong core positions. And I decided, you know what, I want to have a strong NASDAQ presence and Russell presence. So I made these guys actually quite big and I accepted it. but I'm starting to rethink my strategy, and this is again why you do a rebalance. If you look at QQQY and IWMY, on the other hand, theirs is at 2.5%, which is well within my 5% range. They're at 2.2 and 2.1. So if I'm looking at there's overweighting between these two pairs and maybe let's say now redundancy between the two, you are right. That is why this started raising a red flag to me with regards to wanting to do a rebalance, because I'm thinking I want diversity. Because the third goal that you didn't see, I didn't cover when we went over to that my strategy document, was I like diversity. I basically want to mitigate risk by having as diverse a portfolio as possible. And the reason I do that is because I actually go after much higher yields than a conservative income investor would do. And diversification is very important when you're going after more aggressive yields. So with that being said, I decided, you know what? I want to trim one of these. Which one's it going to be? Well, I could have turned around and said, well, let's talk about performance. QDTE and RDTE, they have generally performed better than in the long term than the Defiant pair. Like if you look over here, this over here is the 6-month price trend. And right now you can see that they're actually rising. The QDTE and the RDTE is actually rising in price, which is good. It shows that there's absolutely no sign of erosion here, because erosion would show something, and I'll give you an example of erosion right here. USOI is my poster child of erosion. This is a sign of erosion. When you see the green dot on the left and the red dot on the right, that is a sign of erosion. But over here, you can see that is not the case for QDTT and RDTE, right? Now, if I go to IWMY and QQQY, so here's QQQY and here's IWMY, you could see that it did really look like it was looking bad there at the very beginning of the 6-month window. And then it seemed like it actually improved. And actually, that's not coincidental. Sometime in the spring, early spring of this year, Defiant started realizing, and I'm just speaking on my understanding and my beliefs here. I have a feeling that Defiant was realizing that the customer base, their clients were not tolerating their erosion strategy, because really prior to this 6 months, IWMY and QQQY, they basically were eroding badly. So badly so that basically you could see that I have 951 shares and 982 shares. And you're asking yourself, Perry, why is that such a weird number? The reason that's a weird number is because both QQQY and IWMY about a year ago actually did a reverse split, a 3-to-1 reverse split. So I actually had 3 times the number of these shares as I did before. So they were eroding so badly that they actually reverse split. The Round Hill ones have never experienced that. They've been stable for the most part since their inception. So you could turn around and say, well, if I'm going to reduce something of the pair, why don't I reduce the ones that have given me the most grief? And that's a good thought. But then you turn around and say, hold on a second. History does not make the future. The good news is that it seems like Defiant, when it comes to these two ETFs, have learned their lesson. They've put in protections now, in many factors of protections that have definitely stabilized their NAV. I actually call it QQQY and IWMY version 2, and that was anything prior to 6 months ago, because they have not shown any or no real erosion since they made some of the main changes. And of course, I think what they're going to do with this next major restructuring, if they're switching away from secured puts into covered calls, they're also going to be making it even more stable. So take that off the picture on which is the most stable. You have to turn around and say nobody's the clear winner. Really, they're both actually quite stable, and erosion's not a factor. So if that's the case, why don't we look at yield? So then we turn around and say, okay, well, which one is generating you the most yield? Well, if I go over here, which shows my current and 6 month, and I'm just got to look forward here. So for QDTE, my 6 month average is 32% for QDTE, and for RDT, it's 39%. It's pretty much doing a little bit better with regards to its latest one, but I like using averages. And if I compare that to QQQY, I'm just got to find it here, it's 42 and 57%. So in essence, if I'm looking at the 6-month average, the Defiant pair is actually outperforming the Roundhill pair with regards to yield percentages on a 6-month average. So that's another thing you got to keep in mind is, generally speaking, if I'm going to want to sell off some of these, why would I sell off the one that is basically producing the better current average yield? Okay. Now, that being said, the next thing, it's these two here. So these guys are actually performing better when it comes to average yield generation. But they still pretty much a wash, but these guys are the winners here. So to conclude on my decision on which of the ETFs I'm going to actually sell as part of my rebalancing, the decision started becoming pretty clear is that I was going to basically use the one that basically has lower average yield and is also, if I go way over here, has basically a target, has a net or a current holding weight that is not only exceeding my target, but it's exceeding my 5%. So it actually became a pretty clear decision using analytics that it had to be QDTE and RDTE that had to be the ones that I wanted to sell off and bring down to a more reasonable number. Okay, so that's the reason why on the decision on what I plan on selling, I plan on reducing my positions in QDTE and RDTE. Now we go on to the next part of the anatomy of a rebalance. If we know what we're going to now sell, now the question is, how much are we going to sell of it, and what are we going to buy with what we produce as proceeds from what we sell? So this is the nice thing on why I like using a spreadsheet, because I can actually do my own chicken scratch mathematics right inside the spreadsheet. When I'm done, I'll delete all this. I created this whole thing right here over the last couple of days so that I could sort of come up with calculations on, let's go through a rebalancing exercise. So let me walk this through to you. Again, you guys don't have to do this. This is just me being the analytical nerd that I am. I said, let's figure out what it's going to be. What will the final target be when I actually come up with a plan to execute? So we'll start over here in this top corner here. I want to just box here. We'll talk into this box right here. What this is this is showing QDT and RDT, and I'm using the metrics that are coming from the spreadsheet so that it helps me sort of figure things out. So in the current state, I call it the before state. I basically have 1,900 units of QDTE and I have 1,800 units of RDTE. And I'm going to point out this right here. This is my how much should I sell versus how much should I keep? So the remain says that if I were to keep 30%, that I'm selling 70%. So based on these two metrics here, if I follow a plan of saying I'm going to sell 70% and hold 30%, what it's saying that is after I finish selling my QDT and RDT, I'll only have 570 units left and 540 units. What that means with regards to NAV is I'm going to have 92,000 left and 84,000 left. Or sorry, I have 92 and 84,000 right now. When I finish selling as part of the sell portion of my rebalance, I will only hold 27,700 and 25,000. If you want to know what that means for target, this is good news for me, is I move away from a 6.2. If you go look at point over here, I'm moving away from a 6.2 and a 5.6 target weight down to a 1.9 to 1.7% target weight. Now, that is lower than the 3% average that I would have wanted for something like this. But the reason I'm okay with going down to under 2% is because I've literally got twin sisters running with regards to Defiance, QQQY, and IWMY. So therefore, I really don't look at this. I look at this and blend it with my Defiant, and I'm still over 5% if I add those two together. So I'm okay actually selling more of this one because I want to use the proceeds to actually look at other higher yielding options And again, I'm going to also talk about the other reason I want to do this is I want to actually add to my core, and I want to add to my diversification of my portfolio. So that's why I'm going to use the proceeds. So based on a 30-70 and selling 70%, I will be able to from the sale of the 70%, I will have 64,000 coming out of QDTE that I could use for buying something else, and 58,000 coming out of RDTE from the sale of 70% of its stock. So basically, my cash balance when I actually complete the sell part of my rebalance will be that I have a bucket of $123,500 that I could use to go buy other things. The other thing I wanted to do when I'm doing the calculations of the before and after is currently I'm generating $6,100 a month from the RDTE before I do the sell. And when I finish the sell, it will actually be going down from $6,100 down to $1,839. And I will talk to you about how that affects the net when I'm finished. I'm using latest yield, not average yield. I would like to use the average yield, but the new incoming ETFs that I want to look to compare to don't have 6-month averages in some cases, or I don't track them. So unfortunately, I'm going to only use the latest yield numbers, not the 6-month average. I would have preferred 6-month, but I just don't have those metrics. So my comparison is going to be based on the current or latest yield. All right. So if that's what I've got to work with, now the question is, what should I buy? And this is where I talked to you at the beginning of the video. I was initially quite excited to saying, you know what? If I'm going to sell Round Hill ETFs, why don't I buy new Round Hill ETFs that basically keeps the money within Round Hill, but uses a different components that actually generate higher yield. And I looked at the first, what's called the weekly pays. And let me go over to there. And so I'm going to talk about all of these, the weekly pays and my final decision of what I want to actually use. Let me switch over to that. Okay. So my initial decision before I pulled my video was that I was going to actually buy a whole bunch of these ones. AVGW, I already had COIW, I already had HOOW, but I was going to also add GOOW in there as well. So I was going to add them and basically have a pretty strong weighting of each of them because I basically thought that they were leveraged cover call ETFs, and I'm totally okay with leveraged cover calls. Matter of fact, I prefer a cover call ETF that does leveraging. But then somebody pointed out when I just opened up the video, thank you whoever that viewer was that pointed it out, and then everyone else did too. They said, no, Perry, unfortunately, these are not covered calls. They are actually leveraged swap agreements. They do, and I had to actually, first of all, research more what that was. I've heard of them, but I didn't know. And I did more research. And I basically changed my strategy now because of that. First of all, I'm going to warn people, like, if you are looking at these for yourself, be aware and do your own research and decide if these are tolerable for your risk appetite. These are very risky. They are very volatile. They can go down as fast as they can go up. My HOOW, I bought it a week and a half ago, and 6 days later, I'm up already $12. Now, that was coincidental because Robinhood went onto the S&P 500, so that made a big boost. But that could just as easy go down. Like literally, I could be down at $50 or $40. So these are very high swinging, very volatile. So if you're looking at these yourself, please do your own research. But anyways, I'll go back to mine. I made a decision that I'm not willing to do the kind of target weights that I was going to do on these. Like it was going to be like 3% each. And I was actually going to get a very good return, a good yield boost on that. I'm now going to consider them very high risk. And when I do anything that's very high risk, I always try to keep my target weight down to about 1%. HOOW and COIW, which I already have, is at 1.2 and 1% already. So I decided, you know what? I'm not going to sell them off. I've decided that they are already in the, quote, dip your toe in the water type weight. So I'm going to hold them, even though HOOW is a little bit higher than the target. I also then decided I'm only going to add AVGW. in here. AVGW is right here. It is the Broadcom one. I liked it because it has an 86% distribution rate right now. I decided not to get GOOW, even though I wanted it, because I just said I'm going to be dipping my toe too much into these high risk. But as a compromise to this, I decided what I was going to do is I was going to also then, instead of GOOW, I'm going to buy into WPay. And WPay from these weekly pays is literally an umbrella holding ETF. You've seen them with several others. If you're used to yield max, you know what YMax is. WPay is like a YMax. It holds all the others together and gives you an average. It pays out an average. It's an all-in-one. So for Round Hill's weekly pays, it's called WPay. I'm going to do that instead of GOOW. I'm going to actually buy WPay, and I'm going to, because it actually is an umbrella covered call of all of these other ones here. You can see all the bubbles around it. I'm going to allow the weight to be higher because it basically has protections just because it's actually made up of several of them. So I'm going to actually allow this one to have a higher weight than a dip your toe in the water. And so that's what I've decided there. Now, because I decided that I wasn't going to invest as much in the weekly pays, I still had a lot of money from the sale of QDTE and RDT on the table. And I said, well, what else am I going to buy? Because not only was I looking for an increase in my monthly distributions, I'm always looking for ways that I can continue to diversify my portfolio so it becomes more and more bulletproof from any major downtrends or from maybe one ETF going rogue or an ETF company that's having issues. So I'm always looking for ways of continuing my diversification. As you guys can see from my portfolio, I have already 29 ETFs. This is going to add more. I don't mind having a lot of ETFs because I do like diversification. I basically must have OCD in it. So I said, well, what else am I going to buy to use up that money if I'm not going to actually overinvest in weekly pay? I looked around and I saw, because of all of them being actually, I'm going to focus on a lot of them that are higher risk, higher yield. I'm going to do a few other dip your toe in the water ones. So the first one I decided to do is looking around. I'm going to look at getting this one here called TQQY. It's from Granite Shares. Again, I'm going to give you a warning. And again, I think I said this before, but if I haven't said it before, I'm not a licensed advisor or an expert. So please do your own research on your own ETF decisions. Don't take my word for it. This is just me doing my decisions, and you're just listening to it, and you can decide on your own. So I've decided to buy two of the Granite Shares yield boosts. One of them here is called the TQQY. I'm going to look at putting a portion into this one. It currently has a yield of 51%, which that's a nice yield, but actually for the NASDAQ type cover call ETF, that's a very good return, because any index-based cover call ETF tends to not have yields this high. You can already look at QDTE and QQQY. They are NASDAQ indexed cover call ETFs, and they're running at only in the 39 to 42% range. This guy goes 51%. The reason it does 51% is because they're being very aggressive on leveraging. They're doing 3 times long position. You can see over here. So that's going to help. That's going to really push their yield. Of course, you can only imagine that means not only are the distributions going to be better, but you're also going to get a much more wilder swinging cover call ETF. So again, some people in my comments, when they ask me, Perry, how do you decide on what ETF you're going to buy? Well, I'm actually walking you through it right now. So I've looked at these. I like this because it fits a niche into my portfolio, because I'm looking for a higher risk dip your toe in the water one. That is this one, because I'm only going to put about 1 to 1.5% into this one. Then the next thing I'm looking at here is I like the yield. Granite Shares, I don't know that well. So again, adds to the unknown, which adds to risk. Again, that fits the category of still being a dip your toe in the water holding weight, again, 1%-ish range. But the next thing I want to know, which is always a concern for me, I'm always want to keep my eye open for it, is has it shown any form of NAV erosion? I don't want to buy anything that is already showing a consistent flow of NAV erosion. So how do you look for NAV erosion? So I went there and called up its chart. And you can see I've got the chart up now for 1 year for this covered call ETF. It hasn't been around for an entire year. So you can see it started somewhere, I don't know, February. So basically this ETF is only since February. You could see initially they had some major downturns. I don't know if it's NAV erosion or not, or what the reason is, but you could see once it reached the $18 to $20 range, the good news is they seem to figure something out. And this is good news. So what made me comfortable that I'm okay buying into this is it looks like if there was a NAV erosion issue, they must have made some fine tuning to their prospectus and they basically executing it and saying, hey, we got to fix this so we don't keep going down. You can see quite clearly after April 8th, they really started fixing what they have. And it's actually stayed in this, what I refer to as a price box. You're always looking for a covered call ETF to sustain some form of a price box. Some price boxes are very wide, some are very narrow. So what this one is showing here, it's got about a $2 price box from a low of 18 to about a high of 20. But regardless, it has a price box and that is good news. So that being said, I felt comfortable that this would be a good choice. The other one I'm adding to it is also from Granite Shares. Is one that I don't have any exposure to, or not, I don't have any direct exposure to it. I wanted to have a little bit more on the S&P. So the other one they have available right now is called YSPY. It's YSPY. I'm interested in that one because I'm actually underweight in the S&P. There are things that are similar to it, like my USCL and my HYLD, but this one would basically add to that. It also maintains a 50% yield. You can see it over here in the corner, which is nice. Again, for the S&P to reach 50%, that's pretty good. You won't normally see anything like that in the covered call ETF world that would exceed into the upper 30s. Again, the reason they're succeeding with this is because they've actually tied it again to a 3 times long. So it means they're basically really leveraging it quite strongly. Now, the question is, if they're doing that, you're going to likely see wilder swings. And for the same reason when I said, let's check to see if there's erosion, I went and looked over here. I opened up its price chart. It also started same time. Looks like they started on the same day. They had the same issue where initially they were actually going down, and somewhere around April, they must have made a prospective execution change or something. Something changed because after this date for both the QQQ and for the S&P, you can see that it now also is maintaining a price range, a price box. And that price box looks like it's from right here, it's $19 to about as high as $21, but let's just say it's staying around the $20 range, which is good. The good part is it has a well-defined price box. It has had some drops in here and has a drop here again, but I can say that those drops are not because of NAV erosion or from distributions, because if that were the case, we would be seeing these drops on every distribution. There must have been things that happened here that basically caused these to drop. I don't know what the reasons are, but it's not because of NAV distribution or distributions, because you would have saw these drops happening every time they do a distribution. So that was my decision with regards to the other one that I want to buy. Finally, another one that I wanted to buy into using the sale of QDTE and RDTE is one that's actually going to meet another goal of mine. And this is why I like my rebalance. The rebalance is actually delivering on several different things. It's rediversifying, it's increasing my monthly revenue stream. But the other thing that I really like, and I'm going to actually invest in this one, I was going to do it anyways, and now I actually can use the proceeds to do this, is I'm going to be buying into the new covered call ETF from Canada. I apologize to the Americans that won't really be able to leverage this one, but this one is out by Evolve. I really like Evolve as a company. Their ETFs that I hold are rock solid stable on NAV and on distributions. I actually say that they're just downright boring because literally whatever they pay, it seems like they pay that month upon month upon month on month. They never vary. And so it makes me really feel good as an investor to say I don't have much of a problem buying another cover call ETF from Evolve because I know their history as a company is, that I've invested in has been rock solid. The reason I like this one is that first of all, I think I told you, I like cover call ETFs that use leverage. And almost all the cover calls that use leverage all say 25%. Well, the good news about this one is it's actually, I think, using 33%. Here it is over here. They're using a 33% leverage. So they're using more leverage than anybody else. And I'm like, okay, I'm down with that if it can help increase my distributions. So the great news about that, they haven't put the formula here, but they already know what the first distribution is, which is 31 cents, 31.3125 cents a distribution. Now, the good news is they're paying every bi-weekly. So that means that they're doing this twice a month. So it's actually 62 cents to 62.50 a month. That naturally brings it up to an initial yield of 30%. 30% for a U.S. equity ultra high yielding Canadian cover call is amazing. Like 30% is great for this. So this is already becoming very popular amongst the Canadian cover call income investors. I wanted to get into this already. So my decision here was that I'm going to actually add Biggie. And that will this will become a core component of my portfolio. If you watch my strategy, I have about 40 to 50% of my portfolio holds core, stable, moderate to high income ETFs. And then I have about the same amount of portion, 50%, that I focus on ultra high volatility ones. This is going to be added to my catalog of core moderate positions. Okay. Now you know what I'm going to buy. So now let's go to the last part and say, let's put this all together and figure out how I'm going to break up the proceeds from the sale into what I'm going to buy. And we're going to go to the spreadsheet again. Now, looking at the spreadsheet, now that you can see, here's where my decision was that I was going to buy this one AVGW with a nice 93% current yield. Don't know what it's going to be average. Here's the WPay that I talked about. They don't have a yield for it because it's so new. It's just been released recently, so they don't yet have it. But my estimate is it's going to be about 45 to 50%. So I'm going to go on the low side saying that its yield is going to be around 45%. Here's the Y-SPY, which is from Granite, and here's the TQQQY from Granite, which again are two high volatility ones. And then here's Biggie from Evolve. So what I decided to do is I was going to break them up, and I said, okay, here I already said Hui is at 1.2, Koi is at 1%. These are not going to change. I put them there because it's all part of the big picture. So these are not actually part of the redistribution or the rebalancing. I just wanted to have them there because they're actually part of the family that I'm going to be making changes to. So I'm adding to the weekly pays of HOW and COIW by adding AVGW. And I'm also going to add the umbrella all-in-one to that weekly pay. So these four are going to be the weekly pays section. Every one of them are in the dip your toe in the water trial period. So you can see 1.2, 1%. The only one I'm willing to go to 1.5% on is AVGW. The reason I'm doing that one is because I don't have any Broadcom. So I like it for diversification because it's finally an underlying that I have no holding on at all. Whereas I do have Robinhood, I already have Coinbase. So I wanted this one, I'm giving it a leeway and I'm going to increase to 1.5%. And this one here, I'm also going to allow it to be 1.5% because it's less risky than any of the individuals because it's actually holding all 15 of them. So I let this one go to 1.5% of holding weight. Then with these two here, YSPY and TQQY, I'm going to initially give them a holding weight of 1.5 and 1%. The reason I'm giving YSPY a little bit of a higher number is because I don't have as much weight in S&P. So I decided I'm going to give it a little bit more weight. And then TQQY, because I already have QDTE, I already have QQQY. So I decided I was going to basically make TQQY down to the dip your toe in the water level at 1%. And then this one here was going to take the remaining balance. And it turns out that the remaining balance is almost 3%. I'm going to make the target weight for Biggie at 3%. I might actually make it, put it up to about 5%. But initially, I'm going to be dipping my toe in the water with this one. And I won't say dip your toe. I'm taking a big position in Biggie at 3%, and knowing that I'm likely going to tell my portfolio that I'm even going to allow Biggie to go up to 5%. It's going to be definitely a core holding of mine. Now, that being said, and I took these out because they're not part of the actual rebalance. So that's why you see NA and NA. So you noticed here that the after sell portion is that my QDTE and RDTE will drop from $6,100 a month down to $1,800 a month. But adding these guys from the sale of these is going to add $5,100 a month. So let's go over to this side and say, well, what's the net results? Now we're talking about this corner over here. Okay, so at the very top section is the before and after at a high level. Before the rebalance, I basically was going to have a total monthly, and that includes adding HOW and COIW into it so that it's a whole picture. It basically is, as of right now, I'm generating $8,550 from QDT, RDTE, HOW, and COIW. After the rebalance, it's going to actually go to $9,407. So it's actually a change or an increase in my monthly portfolio income of $857. Not bad. I mean, it's a good number. You can see the numbers are live because it changed as I was speaking just now. So, but the good news is after the rebalance, my monthly income is going to go up by $800. And at an annual perspective, I'm basically going to add $10,000 to my yearly yearly income when I'm done after this rebalance. Now, to actually show what the breakdown is of everything in there, including the two that were not changed at all, and you can see reduced, same, new. So you can see that the reduced income for QDTE is $874 and then $965. HOW and COIW are $1,400 and $938 right now. So that's how much they're already generating as we speak. So they're not part of the rebalance. And then, as I said before, these are the adds of the new ones: AVG 1700, WPay, SPOI. So here it says basically the same number is at 9404. Here's 9404. And basically, all these combined, when I'm done, will generate about $112,000 a year from the after rebalance. Okay, so that is the decision I'm going to make. Now, the last thing I want to bring up before we call it quits on this thing, and I'm just going to switch away. I'll leave it here for a while, just so anyone wants to look at the video, the spreadsheet. The next thing is timing. So how am I going to do the rebalance? Because the anatomy of a rebalance says, okay, we know why we did it. We know what we're doing. We know where we're going with this, with the new balances. Now the question is, when are we going to do it? So what I'm going to do is, today would have been a perfect day to do it, but the market's already closed, actually as of about a few minutes ago. Chances are I might actually sell QDTE and RDTE, start selling them tomorrow. The reason I'm saying, because you guys are watching this video, you don't know what tomorrow means. Today is the ex-dividend date for QDTE and RDTE. So they've already have locked in their weekly distributions. I would sell it today because I would lock in the last distribution. It's 6 of one and half a dozen the other. Because I did that, I'll also see the drop in the price. So I could have sold it anytime, but I plan on I just was planning on locking in that last distribution. more for emotional sake than anything else. I could have actually sold it for higher if I would have done it before ex-div date. Once I get all the sales out, I'm going to then start focusing on buying these. Now, I think my strategy is going to be, because this is a very complex rebalancing, I have 6 accounts. And doing this across 6 accounts is a lot of trading work. So I'm not going to rush this because I don't think there's anything to rush on. You know, you might lose on it in some ways, but in other ways, by actually breaking this rebalancing up on an account by account basis, I might actually gain things because, for example, AVGW is on a tear right now, but next week it actually could go and decline and drop really low. So over the span of, say, 2 weeks or whatever, I'm going to tackle one account at a time and convert each of my 6 accounts one at a time to switch over to this. All right, so that's what my plan's going to be. And I feel by doing it that way, I'm actually going to maybe cover some highs and lows in the market. You never know. It might actually, if all of a sudden we have a really bad hair day on the markets and they all go down, I might actually speed up the process because I want to take advantage of any one of these that have actually decided to really drop. Okay, so I know I bored half of you to death. I bet you guys have clicked fast forward about 100 times. I apologize. I'm a very nerdy, analytical kind of guy, and I repeat myself. But that's who I am, and you take the good with the bad. But I'm hoping that you found all this very interesting. Again, watch my videos that I pointed out here, the strategy. Watch the one on the spreadsheet if you can. And if you're new to my channel, please, if you found this kind of strategy discussions on income investing very valuable, I would love it if you press the subscribe button. This takes a lot of work and it would be appreciated with a subscribe. So until then, I'm going to basically say to you guys, stay safe, stay investing, and I'll see you in the PIIverse.